Today, we're going to be talking about how people can trade commodity futures in the Chinese market. So this is going to be a comprehensive guide to basically everything you need to know to get into the Chinese market and to successfully trade. We're going to start with a very brief overview of why would you actually even want to be in China? Now, there are three very straightforward points to answer that question. The first one is liquidity, because China, as one of the largest consumers and importers of commodities globally, has very deep markets for any kind of product, ranging from metals to agricultural commodities to petrochemicals, and really everything in between. So that means if you get access to China, you get access to a huge liquidity pool. The next thing is that China is looking to establish its pricing power. China is already a keynote in the global trading system, especially for commodities, obviously, because of its consumption, but also because it is so integrated into the global trading system. And at the same time, the Chinese market follows its own domestic dynamics as well. So as China's prices and China's commodity prices gain importance in the international market, as they become benchmark prices, it's important to be familiar with the dynamics within the Chinese commodity market and to basically understand them from within and potentially to be able to access them should prices diverge, for example, in the international and domestic Chinese market, like, for example, what we saw during COVID. And the third point here is one that might be surprising to people that haven't been very active in the Chinese market or that don't know much about it. It's that it's actually a very, very well regulated and very safe market. In fact, the entire regulatory structure and legal framework for both domestic and overseas market participants is extremely strong, and it ensures stability for everybody in the market itself, price stability, but it also protects client assets. So that means if you're trading in the Chinese market, you can be sure that you can get your money out anytime and it's not going to disappear anywhere. This is really something that over the last 15 years, 20 years, they've been developing in China, their framework, and it is something that I will be going a bit in depth later on as well, because I think it's quite a unique way of regulating the market and something that is quite a positive factor for anybody thinking about accessing that market. Now, a very brief overview of what China's futures market actually looks like. China's market, it began to develop in the 1990s, essentially as China's economy was liberalizing and as it was opening up. Obviously, private companies were increasingly active, and they had to sort of ensure that they could lock in their input and output prices, especially as China was obviously very deeply engaged, especially in the primary and secondary sectors of the economy. So there wasn't much of a service sector just then. And so obviously a futures market, or back then it was a forward market, but it gradually became a futures market after a bit of back and forth and a bit of regulatory, trial and error as well. Was certainly quite wild in the 90s. Not that I can tell you that from experience, but at least based on my reading materials, that's certainly the case. And this development has really continued over the last 30 years. At some point, there were a large number of exchanges. They were consolidated. And then in the mid-2000s, 2010s, I think we sort of saw the structure of the futures market emerge the way we know it today, with the 6 basic exchanges that I'll be introducing shortly. The latest of which, the Guangzhou Exchange, was only established in 2021, with its first product actually being launched only 2 years ago in 2023. In China, the major exchanges, especially the SHFE, DC, and ZC, they are all state-owned, and as such, they are actually member organizations and technically non-profit organizations as well, which I think sort of distinguishes them from their overseas counterparts as well, since they really don't have a profit motive for themselves necessarily, but are purely there to provide a venue for price discovery and risk management for what they like to call real economy. Because the idea obviously is, well, why do you want to have this financial market there? It is there to serve the underlying real economy and make sure that hedgers have access to a venue for price discovery and managing forward price risk. And as such, the contracts are designed to suit the widest possible range of users, including smaller companies, as well as obviously gigantic multinationals. And as a result, a lot of these contracts tend to have smaller contract sizes than the international counterparts. But the benefit from that is that you gain liquidity from a lot of smaller users that also enter that market, and especially industrial users as well, for who these contracts aren't too large. So that means you have a quite diverse range of market participants. And ultimately, while the exchanges are state-owned companies with a primarily domestic focus, guaranteeing price stability, pricing venue, etc., their teams actually draw from experience from the global sort of international market. So in my meetings with them, I've encountered lots of very, very sort of international-minded people, a lot of them with international experience. Many of them have worked at overseas exchanges. So they bring that sort of domestic international experience into the domestic market in China. And they really combine that to, on the one hand, definitely follow sort of innovations in the international market, make sure that they move forward. But at the same time, they're also looking for sort of their own pathway in this entire process. And the other thing that I think is quite attractive to anybody who just wants to take a look at the market, maybe isn't quite sure yet, is that it's a very open and transparent market. All the trading is electronic, and as a result, historic and live market data is very freely available. So in that sense, it's very easy to just really test the waters in that sense. It doesn't take a large investment to get started. Now I'm just going to run through essentially a basic overview of what China's futures exchanges actually look like, what the exchanges are. It's going to be very high level. We're just going to really go over, okay, what are these exchanges actually? And then later on, we'll dive into more detail on how it actually works to be active in that market. As I mentioned, right now, China has 6 exchanges, the Shefi, INE, DCE, ZCE, Guangzhou Futures Exchange, and CFEX. And they are all quite distinct in terms of their product offering and focus. So they are very much designed for a specific purpose. They don't necessarily compete with each other so much as they really have a certain mission to implement, depending on their history, their location. And that's really how this market has developed in a sense. And as I mentioned, futures and options are all traded electronically on a screen. So there is no voice market. Everything is out there. It's on the screen. And essentially what you see is what you get. This is, again, because China's futures market is quite a young market in a sense. So you don't really have that long history of voice markets, of in-person trading floor and all of that. So essentially, as soon as electronic trading became feasible, the market just moved towards that. And today, if you visit the exchanges, you can still see the trading floor at the exchange, but it's more a museum than an actual venue for trading anything at this point. It is very nice to be visiting, though. I can definitely recommend it. You can see all of those old fax machines, I think, still sitting around there. And ultimately, as I mentioned, you have historic and live market data. It's available, and that way, it doesn't matter if you're a large company or a small company, everybody has the same access to that data, which again makes it a very, very transparent market, both for small and large financial and industrial enterprises. The first exchange to really look at is, I think, the perhaps most well-known in China, the Shanghai Futures Exchange. It's, I would say, the most international exchange in a sense, obviously based in Shanghai, this international trading city. And its focus is quite wide. It covers metals, including precious, base metals, as well as steel. along with some energy products and also several industrial ones. In total, they have 23 futures and 13 options contracts. This includes several INE contracts, and it is actually sort of the owner, the parent company of the INE, which is the International Energy Exchange. And right now, it is a purely domestic exchange, but it is working on opening up its first contract, which is going to be the nickel contract that we expect is probably going to be launched, rather opened up sometime this year. As I mentioned, the International Energy Exchange, this is the second exchange based in Shanghai, and it is a pure subsidiary of the SHFE, and it is a fully internationalized exchange. That means, unlike the SHFE, where trading is limited to domestic Chinese companies, the INE is really open to anybody, including for physical delivery. So yeah, it doesn't matter whether you're a domestic Chinese or overseas company, you can participate in every single contract that is available on the INE. And it is the first exchange that really allowed overseas brokers to also become exchange members. So it is essentially a sort of testing venue for trying out new ways of bringing international market participants into the Chinese market. And as I mentioned, China has quite strong liquidity across all contracts. Basically, the average daily volume was over 500,000 lots in 2024, and turnover was also plenty at almost $18 billion there. That's the average turnover, obviously, not the total for the entire year. And right now, we have 5 futures contracts and 1 option contract available on that exchange. Next is the Dalian Commodity Exchange. I think Dalian, a city that perhaps not everybody is too familiar with outside of China. It's in the sort of very upper right corner, a bit close to Korea as well, that sort of area. And again, sort of due to its location, it's very much focused on agriculture and industry. Right now, it has 22 futures and 17 options contracts. And out of those, 6 futures and 5 options are available or open to international investors. And here, one thing that's important is to distinguish between this and the INE. The INE is completely open. All the contracts are available. On the Dalian exchange, it used to be a purely domestic exchange, and they have step-by-step opened up several contracts to international market participants. That means they were allowed into that market. And right now, those internationalized contracts include iron ore, palm oil, soybean, and plenty of other soybean products. And it is, again, quite large with 2.1 million investor accounts, 530 warehouses, and I think their record annual volume a couple of years ago was 2.3 billion lots across all contracts in 1 year. Also, sort of in the more, central northern part of China is the Zhengzhou Commodity Exchange. This exchange similarly is very agricultural and industrial focused. It also is a mix between international and domestic contracts with a total of 26 futures, 19 options, out of which 4 futures and 3 options are available to overseas investors. And last year, it saw 2.6 billion lots traded with a turnover of over 85 trillion renminbi that year. And it really was one of the first exchanges to be launched back in the 1990s, originally not as a futures exchange, but more as a forward market. But unlike many of the first exchanges that were launched back then, it actually survived the wild 1990s and still remains as one of the main commodity exchanges in China today. The newest exchange, again, as I mentioned, is the Guangzhou Futures Exchange. It's very much focused on new energy and technology. So right now it has 3 futures and options. Those include polysilicon, industrial silicon, and lithium carbonate. So you can see based on that selection, it's quite distinct from the other contracts. These are all very sort of 21st century contracts. And it is designed with that in mind. It is supposed to sort of become, or rather, it already is the benchmark for pricing lithium and silicon. And that's sort of its objective for the coming future as well, as they add more contracts, obviously. The last exchange to mention here is the CIFEX, China Financial Futures Exchange. This one is also based in Shanghai. And this is basically, again, based on the name, you can probably deduce it. It's where bond futures and stock index derivatives are traded right now, with 11 futures and 3 options available. And it is essentially China's only dedicated financial derivatives exchange. With that, we're going to jump into the actual opening up process. And again, first, well, China's opening up, okay, but why is this happening? What's actually going on here? Well, so the idea very much is to build a stronger influence in the global commodity futures market, and to really build China as a mature pricing center that has international influence. This is, I think, usually just referred to as the China price, the idea that China should not just rely on various international exchanges like the LME, like the exchanges in the US, on pricing, but rather China should have its own exchanges with its own products that can reflect a at least sort of regional price that might very well differ from the overseas price. And again, this entire thing is sort of part of the effort. And I think a lot of people that pay attention to China, they might hear about discourse power. It's all this idea that they want to enhance China's voice in the global economy, as China obviously has become a rather significant part of this global economy. The idea is to make sure that its strength in the financial market reflects its position in the industrial and trade world of today. And the other part that is very, very important, obviously, is that the futures markets, as they open up, are supposed to help with the rational allocation of resources by essentially bringing together the Chinese domestic supply and demand dynamic with the international dynamic, because especially in contracts where you have international market and you have a closed Chinese market, these can move in very different directions just because there is no way to actually bring them together. And by opening up these contracts, you essentially bring together both physical and financial investors from the international and domestic market, and they can find a price where basically they balance out the Chinese international sort of point of view. And again, for the longest time, China saw itself as big but not strong. A couple of these quotes I've taken from discussions recently at the NPC and CPPCC, where basically the latest policy meeting in China, where obviously there was discussion about the further opening up of the commodity markets as well. And essentially, the summary basically of China's position for the longest time is that all these physical commodities are traded in the East, priced in the West, denominated in US dollars, and all obviously based on futures benchmarks. So the question is, why should China rely on a US dollar price somewhere in the US when it is the largest consumer of most of these commodities in actual fact? And so essentially since 2018, we've seen a process of really trying to build a world-class futures market, and world-class really being the official term used by the regulators and state council when they make policy decisions. And the point of a world-class exchange is that it is an exchange that is obviously in line with global standards and open to international investors as well. And since 2018, we've basically seen the opening up as in essentially 2 separate avenues. The first, as I mentioned, is the crude oil contract, where a completely new contract was set up on a separate exchange, the INE, which was set up specifically to be a bonded exchange that is completely open, exclusive of any VAT. So it means you're essentially trading the international price, but for products located in China. So essentially, you don't have to take into account VAT here. But this means because it was a new exchange, new contract, it really had to sort of establish itself first before it came accepted. The iron ore contract, on the other hand, this was also launched in 2018. This was a pre-existing domestic-only contract. That means the price there is inclusive of Chinese VAT. And what the Dalian exchange did is to simply take this contract and just invite international investors into the market to just participate there already. So that means you had an existing contract with existing liquidity, and you just invited overseas investors to come in and take part in that. And I think when the oil contract was launched, especially, there were questions on the international side of like, okay, why do I need a Chinese oil contract? Why do I need that if I already have WTI, if I already have Brent and plenty of other benchmarks? And so from the international side, initial take-up was quite slow because, again, why do you need another contract? However, all of this was launched in 2018 and developed throughout 2019. But then towards the end of 2019, I think we might remember something happened in the name of COVID. And obviously, China was hit very early on, lockdown, and it sort of emerged already in early 2020 by the time when COVID was just starting to spread in the US and Europe. So that means as China's factories were basically beginning to run at full steam, the US and Europe were shutting down. And obviously, this was a huge demand shock for oil prices. So WTI in the US went negative, briefly hitting negative $30. Brent was trading around $19. And at the very same time, INE crude oil stood at a positive $31. So that means you essentially have a price delta of almost $60 between the American and Chinese oil contracts. And this resulted in a huge arbitrage opportunity for anybody who had both physical access, who could take delivery in the West and make delivery in China, and at the same time lock in the prices in both markets as well using futures contracts. And this COVID shock really sort of shook up traders in a sense and reminded them that even in this globalized world, regional dynamics still matter. So you have different dynamics in terms of supply and demand in different regions of the world. And so that means your Chinese oil contract is not always going to behave exactly the same as your US or European oil contract. Obviously, COVID was an extraordinary shock. But the fundamental logic still holds that ultimately different locations will have different dynamics and thus may at times need different prices to balance supply and demand. And so since then, we've seen a quite noticeable influx of traders, just ourselves, but also in the overall market. You can see the same trade from outside China. And so for us, we've really seen China-bound volumes surge from, at the beginning, a very, very negligible fraction of our total volume and into something that at times almost made up 50% of our client trades. And it used to be, again, the case that client margin was held almost exclusively in USD. But as the Chinese market developed, the Chinese market is priced in renminbi. So that means we've seen more and more clients actually hold RMB balances in their accounts. And I suppose the biggest beneficiary actually turned out to be not necessarily a Chinese contract, but rather the SGX USD CNH contract, which obviously everybody who is especially trading arbitrage between the Chinese and overseas markets is using, along with the actual trades to hedge their currency risk. And so we've seen from 2020 to 2024 a over 400% increase in the volume of just that specific contract. Again, just as the FX price risk management obviously became more and more important for anybody who was active in the Chinese market, but ultimately exposed to US dollar P&L. And so at this point, it's actually pretty much the 6-year anniversary of the launch of the Shanghai crude oil contract. So it's very much 6 years now of opening up. So essentially, the question is, okay, where are we right now? And essentially, since the INE, DC, and ZC, so the Shanghai, Dalian, and Zhengzhou exchanges fully or partially opened up, we now have the Shefi also getting ready to essentially follow suit and open up some contracts. As I mentioned, in this case, it's going to be the nickel contract that we're likely going to see this year. And so at this point, we now have 24 futures and options contracts that are available to foreign market participants via overseas brokers. So that includes somebody like banks, but obviously any other broker as well that can provide the so-called overseas intermediary access to the Chinese market. And these contracts really include anything from quite well-known contracts like crude oil and iron ore to more unusual contracts like PTA, TSR20 rubber, container freight futures, and even peanuts, all of which are quite special, quite specific to the Chinese market, but also, again, very, very liquid because you have that Chinese liquidity pool that if you're trading these contracts, you as a foreign investor can essentially tap into. And again, even though for maybe financial investors, these contracts may be relatively new, certainly for industrial companies that are active in these commodity markets, these contracts already serve as their benchmark contracts in many cases. And in fact, quite often we now have not just these contracts here, but we have overseas listings of these same contracts. So, for example, we have in Osaka, I believe, a rubber contract that is based on the TSR20 price. We have, I believe, soybean oil in Malaysia that is, again, settled against the Chinese price. So all of these are already quite significant as benchmarks for the physical industry and definitely worth a look, I would say, for anybody who is not familiar yet with these market dynamics. And from here, the question is, okay, where do we go? And for that, we can essentially look at basically at what the regulators are telling us, because people often maybe treat China as a black box, but I would say that's not entirely correct, because actually, if you take the time, you can actually find a lot of information out there. And if you just read what they say, then you get a good idea of over the next few years where we can expect the market to, what direction to move in. And the CSRC, one of the main regulators of the Chinese futures market or securities market, issued late last year their opinions on strengthening supervision and preventing risks to promote the high quality development of the futures market. This very, very catchy title actually was a very interesting read because it contained quite a lot of information on what the plan is for the next 5 years, basically. And the goal, again, is to build a world-class exchange, or rather world-class exchanges. And these are defined as regional pricing centers, i.e. Priced in renminbi, but with international price influence. And the other part is further extending the range of products that are available and also further extend the opening up of the entire futures market. So this is very much on the agenda. As mentioned, Shefi nickel is likely to be the next contract to become available, but we've also seen a lot of writing about the launch of an LNG contract, for example, because again, right now, China, one of the largest importers of LNG, actually doesn't have its own LNG contract. So you don't have anything that actually reflects supply and demand in China for that commodity. And aside from that, we should see a lot more green futures contracts, electricity futures, and other sort of more specialized futures contracts. Not all of which obviously will be international right away. Many contracts will initially be Chinese only, but we will definitely see more new contracts being added to the sort of international batch of products. And the last point here is that the Chinese exchanges are very, very active right now in looking for more industrial participants in their futures markets. So they really are trying to get both domestic and overseas industrial clients to come to their markets, to use them for hedging, price discovery, risk management. And as such, they've been very active in discounting all kinds of exchange fees, reducing margins for hedgers, and especially the Shefi and Aini, for example, completely canceled the brand registration fee for any of their products. Now, having talked about the overall structure of the market, we can now go into a bit more detail. I don't worry, this is obviously maybe not the prettiest chart, but it has a lot of information on it. We're not going to go through all of that. Obviously, if you have questions later in the Q&A, I'm happy to dive into this a bit more. But fundamentally, this is what the Chinese market looks like in terms of just regulators, who is actually in charge of what here. Just a few things to look at. CSRC, we encountered that just now, the China Securities Regulatory Commission. This is basically the sort of big market regulator. They have provincial bureaus that are then responsible for anything that happens in their region. And below that, you have the exchanges. And essentially in here, you have this so-called closed margin loop, where essentially this is the loop where overseas funds can enter China for futures trading. And they can't actually leave this loop. So essentially, you can't just move money in, take it out, do something with it, and then move it back out again this way. It is really purely for futures trading, and it is built in a way that these funds cannot exit from here. So that means if you as an overseas trader deposit $100,000, you trade, you make a profit of $50,000, and you want to move your money back out again, you are going to get your $150,000 back out. There is absolutely no way these can essentially get lost or disappear in China just because it's a closed loop. Obviously, so long as you don't make a loss with your investment. Obviously, in that case, that is the one way to actually lose your money. A few other things to just look at. We'll again encounter those again later. The trading code is essentially a specific identifier. We'll explain that in more detail. And then the China Futures Market Monitoring Center, CFMMC, is very much what it says on the label. It monitors futures market margins, and it has full sort of full visibility of essentially anything that goes on here, at least inside of China. So this is essentially the fundamental sort of protector of this entire market. Now, the trading code, as we just mentioned, is a unique end client identifier that basically when you try and join the Chinese market, you will get this trading code assigned to you as a client. It doesn't matter which broker you're trading with, this trading code sticks with you. And it is essentially attached to everything you do in China. So any funds you have there, any margins, any positions you have on any exchange, any trades you execute, everything is sort of tagged with this trading code. And again, this provides the regulator with a full see-through ability for risk control. So they can essentially identify large trader positions automatically. They don't need any additional reporting. They have full transparency. And essentially what the CFMOC then does is it takes all this information and conducts its own settlement for every single client in the entire Chinese market. So you can actually, as an end client, get your own daily statement directly from the regulator in China. That is literally how it works. As proof, I have the screenshot here from the portal. So you can try it with the CFTC in the US, I suppose, but I think you'd struggle to get that same information from them. So it means the regulator has all the information, and obviously, if anybody tries and do something shady, this will immediately sort of throw a big sort of red flag, and there's essentially no way anybody can get money out of the system without immediately being found out by the regulator. In fact, in terms of risk control, the trading code is sort of the first line of defense against anything that is sort of nefarious. Because again, the exchanges and regulator can see large positions, even when they are spread across multiple brokers. So essentially something that we may have seen in the UK a couple of years ago with nickel. This really couldn't happen in China just because the regulator would always see that it doesn't matter how many brokers you're using, you're always using the same trading code and your position is very clear. And so there's no way you can build up a surprisingly large position that nobody's aware of over months. The next thing, or the sort of second big line of defense, is the combination of percentage-based initial margins with price limits. This essentially eliminates intraday sort of cascading failures, because because essentially the initial margin is large enough to cover intraday losses, simply because the price can't go beyond the price limit, and the price limit is either the same or lower than the percentage of the futures margins. That means you can't lose more money in one day than you have already paid in pre-trade initial margin. And so this essentially prevents any sort of cascading failure. The next thing is the CFMSC is actually working on a real-time market supervision system that will literally give them real-time overview of anything that's happening. And with all of that, we've now essentially established, okay, China itself isn't a problem, but what about your money? Can you actually get it back out of China if you've deposited it? And this is essentially where market access actually comes in. And this is where it also matters which type of market access you pick, because there is a real alphabet soup of different ways of accessing the market. You have WOFIs, you have NRAs, you have QFI, you have RQFI, you have OI, you have OSPP. All of these are ways of getting into China, but depending on how you do it, getting your money out may or may not be very easy. And this is very much why I will focus today on just the OI route here, which is the so-called overseas intermediary route. And it really is the most elegant way of getting your money in and out of China for trading. The way, or rather, just a quick summary of what it actually does, I would say it's really the vanilla of Chinese market access. It's suitable for anybody who just wants a sort of hands-off Chinese market access, without having to set up their own bank account in China or finding a domestic Chinese broker and all of these things. It's all happening offshore. And so this means you get access to the international and Chinese markets in the same account. You can move money in and out of China in less than 2 hours. Again, all of the money doesn't matter how much. And you can obviously do FX conversions. You're not subject to Chinese taxation. You can use US dollars as an initial margin even. And again, account opening is actually happening outside of China, which means it's going to be in English. You don't have to deal with anything Chinese language if you don't have the skill set for that. And with bands, for example, as we're based in Hong Kong, it's all happening in English, subject to Hong Kong law. And again, as mentioned, you don't need to open a so-called non-resident account, a bank account in China. It is all happening offshore. And what does this actually give you access to? Well, right now, the OI route gives you access to total 24 futures and options across 3 exchanges. Plus, again, as mentioned, we're likely to see the SHFI being added to this later this year. In terms of how it actually works, this essentially, if you sort of turn it 90 degrees, is what we saw earlier. This is basically the process through which funds move in and out of China. And this is basically, how your money moves through that system and how it is protected against, any questionable business. And you can see, again, I will leave this here for a moment. During the Q&A, I'm obviously happy to go into more detail, but I think it's already a bit late. So I'll just skip through that and just focus on, okay, how does trade execution actually work? Well, it's very straightforward. As an overseas client, you send your order to Bands, for example. And because Bands offers access to both the overseas and domestic markets, the order then gets routed to the respective market. And because all of your funds are in the same account, you don't need to worry about having different accounts for different exchanges. It's all in the same account. And so if you deposit 100,000 USD, then it doesn't matter whether you're trading in China or in the US or in the UK and Singapore, etc. You can use those funds wherever you need them for paying margin calls, etc. Obviously, as mentioned, Band provides access to the global market. And now that we're already sort of reaching the end of today's session, I just want to quickly summarize what we covered today. Fundamentally, China, when using the OI route, overseas intermediary route, can be traded like any other market. So there's no difference from the client perspective. You have access to a range of highly liquid futures and options contracts. You have the protection of a very, very advanced futures market regulatory system that is there to protect your interests as an investor. And the OI mechanism enables the most efficient and elegant way to literally access this market and getting your money in and out of China, again, not subject to Chinese taxation, and you can get it out, again, in less than 2 hours. And so it doesn't matter whether you're using USD or RMB, even RMB profits can be repatriated and you get your CNH back outside of China. You can convert those freely to whatever you would like them to be. Now, if you have any questions, again, feel free to just put them in the chat. I'll just run through a couple, and yeah, we'll see if anything comes up in the chat later. But just in terms of what we got so far already from the sign up earlier, the first question again was just, okay, what products are available? As mentioned, we have 24 contracts that are available right now via overseas brokers. And the updated list can always be found on the band's website. I'll be sending that to all of you as well later on. So don't worry, you don't have to write down any of these links. You can get access to the slides. And the next question that we got is, how much does it actually cost to trade in China? And I think that's something where anybody would be quite happy to hear that it's fairly efficient in terms of finances. Historical market data is free available on the exchange website, so you can just go there, download it. Bands offers a free trading platform with free Chinese market data. So again, all of that is free. Trading fees, including exchange fees, obviously vary by product. They tend to be in the range between $10 and $30 per lot. Again, depending on the contract. There are some that are a bit more pricey. There are obviously others that can be a bit cheaper. But that is very, very roughly what you're looking at here. So yeah, between $1 and $4 I would say. And obviously, if you're a producer, Chevy and INE are waiving their brand registration fees this year. So if you are thinking about maybe exporting, maybe looking for a exchange warehouse to deliver stock to as a sort of last resort, take a look. We obviously are happy to facilitate that to the extent that we can. And lastly, China's exchanges are very active in supporting industrial hedgers. So again, they have actually reduced specifically for hedgers, which they can identify using the trading code. They've lowered exchange fees and margin levels. So it means as a hedger, you will benefit from these hedger extras in a sense that just make trading a bit easier for you. And so what's the process for trading in China? Basically, when you're using the OI mechanism, it's just like trading on any other market. You get your trading screen, and after opening the account, you just you have an electronic screen. You see the price like, you send the order, and if you get matched, you get the fill. So it's very, very straightforward there. How can foreign market participants engage in physical delivery? This depends on the product. There are some that you can deliver. On the INE, for example, it's entirely open, so you can deliver INE copper cathodes, crude oil, low sulfur fuel oil, natural rubber, all of these you can physically deliver. That's no problem at all. And lastly, somebody else was asking what the opportunities are in the Chinese market. Again, you really get a few key benefits, namely liquidity, diversification, cross-border arbitrage, if that's something you're active in, and the ability to hedge. With that, I think we don't have any further questions. So I'd like to thank you very much for joining me tonight. I hope you got something out of this. There's a few people that mentioned they would like to set up an individual call. We'll be reaching out to you in the coming days. And obviously, if you have any further questions, you can always reach out to us by email, obviously, is the easiest way. But if you want to have a chat instead, obviously, there's a call, or we can set up a video meeting to just go through any questions you have in a bit more detail.